Okay, everybody, welcome to week 2 of Finance 445. This week we'll be covering gifts, which is section 15.4 of chapter 15 in your text. It's kind of a strange course in that we're only covering one chapter as we discussed last week. And 15.4 is like 3 or 4 pages of text, so shouldn't take you that long to read the material, and it won't take us that long to cover all the material from this week. So hopefully we can put an hour into tonight's class. I don't know that we'll get a full hour. There's just not a lot of content. Having said that, we will spend a considerable amount of time on the test. Now, you'll notice on these tests, and this is something that the school put together, and I just get to offer whatever the school has put together on these tests. But you'll notice that this test has 50 questions. It's considered a midterm, so a good chunk of them are repeat questions from week 1 or material from the first couple of sections in the chapter. But basically, because the chapter's so small, what it appears that they've done is they've just used the full test bank of questions. And so be ready for anything from chapter 15 on this week's test. I'll spend some time going over what material, like we have in the past, will be on the test, but just be aware that anything is fair game from chapter 15 as far as the midterm this week. So 50 questions, true, false, and multiple choice, a mix between those two, and shouldn't be a hard test, but it is fairly long since there are 50 questions with an average of about 2 points apiece. So that's this week's test. Mr. Reyes, thanks for coming back in. Sorry about the mix-up earlier as far as the timing. I actually taught a class right before this one this evening, and it was taking a very long time to load in the recording, and I didn't want the loading of that recording to break up our live session. So anyway, the point is, appreciate you being patient with that. I will understand if you need to pop out, early. If you had plans here in the next half an hour to be on to your next thing, that's just fine. Or if it's really late where you're at, that's fine as well. But thank you for coming back in, I should say, and appreciate you being here. We're just talking about what it is that we're going to cover. It's section 15.4 on gifting from chapter 15. We're just talking about how this is kind of a strange course because we're only covering one chapter this entire mod, and 15.4 on gifting is probably 3 or 4 pages is all. So not a big section, not a big chunk of reading. However, the midterm this week has 50 problems on it, some of which I had mentioned before are repeats from last week, but many of which are just coming from the content in chapter 15. And pretty much anything in chapter 15, since it's a mod with 50 questions, is fair game for this week's midterm. So if it were me, I would read the entire chapter. I know we talked about that last week. It's not a big chapter. It's not very heavy. So even though this week's topic is gifting in section 15.4, for purposes of preparing for the test, I would probably encourage you to at least skim through and read through all the content from chapter 15. Any questions with that? Once again, thanks for coming back in. We'll go ahead and get started then. What we're going to do is go through some slides on gifting. Not a lot, like I say, there's not a lot of content. And then we'll spend a pretty considerable amount of time making sure that you understand what topics will be on the test this week. I'll give you a little bit of a preview as far as the assignment, the financial planning question number 6 at the end of the chapter. So we'll take a quick look at that. And then, like I say, a good chunk will be on the test. And then, this course or this class might be end a little bit early just because of the such limited content for this week's material. So, okay, so are you ready to start, Mr. Reyes, or is there anything I can do for you or answer any questions before we get started? So once again, All right, thank you, and thank you for coming back in. So once again, we're just going to cover some of the material on gifting and then some of the preview for some of the coursework this week, and then we'll go ahead and the bulk of the time I think will be spent on the test materials because there's quite a few questions this week. So when we talk about gifting, what are we talking about? Why are we talking about gifting? Why are we spending time talking about gifts? So there's a couple different things we need to look at. First of all, I wanted to just pull up the readings and tools page for this week. There is some additional content as far as some definitions. There's gifts from Investopedia, what Investopedia has to say about gifts. It's got a short section on gifts as well. And then there's a quick video on gifting as well. I think all three of those things, the definitions, the Investopedia segment, and the video are all good resources. Just wanted to point those out. Sometimes in these classes, the readings and tools site just basically point you to the chapters. In this case, it's got some pretty good additional material. As far as this particular in the book is concerned, the book really just goes over gift splitting, which is one of these definitions on this. It goes over the annual exclusion. It goes over your lifetime gifting maximum or excluded, and giftability, the amount that you can gift in life and death. And we've alluded to that a little bit last time, and there are some minor things that are different from what the text says, but most of it's spot on. Most of those numbers haven't changed since 2013, which is what the latest thing that they updated in the textbook. So you don't need to worry that the numbers are incredibly different, just some of the minor rules are different, and we'll go over those. So what is the requirement on gift reporting? The requirement is that if you give more this year than $14,000, okay, to any of your family or anyone in general, okay, that it must be reported, okay? And some people say, well, who cares? Why does anybody want to know about the gifts that I make, and why would anybody need to know about the gifts that I make? Well, the IRS is very interested in knowing about the gifts that you make because there is a gift tax out there, and they will tax the gifts that you make if you exceed a certain amount of gifting. Now, will you get taxed if you give more than $14,000? The answer is no. But do you have to report any gifts above $14,000 in value? The answer is yes, because anything over $14,000 counts towards your lifetime exclusion, which your lifetime exclusion for gifting and estate planning purposes, which are one and the same now, is that $5.45 million. So if you give more than $5.45 million in life and in death combined, then you will owe estate taxes if you've passed, or you'll owe gift taxes if you're still alive. Okay, so that's why they want you to report that. There's a separate form, and many times the biggest cost associated with giving more than $14,000 is just the extra form that your CPA is going to charge you to fill out because they've got to report it. Okay, so you may not ever have to pay gift taxes because you may not give more than $5.45 million. Most of us won't, right? That's fairly uncommon. But that's not sometimes the biggest issue. The biggest issue is we might pay an extra, $50 or $100 for our tax filer to have to file the extra form to report our gift above $14,000. Okay, so the reason that it's mandatory, or the reason there's even a form for gifting, is because the IRS wants to keep track of that so they can count it towards your lifetime exclusion of $5.45 million. And even if you were to tell them, if you and I were to tell them, Mr. Reyes, that there's no way we're ever going to give more than $5.45 million, they would say, well, that's nice. We don't believe you. We can't trust anyone. So we still require you to submit the report if you give more than $14,000 in a year. Now, one of the things that the book talks about, which I think is helpful to just consider, is you might say, well, is this just cash? And the answer is no, it's anything of value. So let's say you give a vehicle to one of your children. Let's say the value of that vehicle is $20,000. Technically, you should be filing a gift tax return along with your taxes that year. and stating that you gave $6,000 more of value than the annual exclusion amount. Okay, so that would be $6,000 towards your lifetime, life and death total exclusion of $5.45 million. And you can see how this is really cutting hairs, right? Because really, is that 6,000 really going to make a big difference? Probably not. But they want to get their 40% tax if you end up exceeding that $5.45 million. So they're going to want you to count everything technically. So if you go and ask a CPA, hey, I gave my kids a car this year, it's probably worth $30,000. Do I even need to report that? The answer from a CPA is going to be, yeah, you do. And I'm sure there's a lot of people who don't report things like that, but technically the rule is anything above that annual exclusion amount of $14,000 should be reported. All right, so that's one example. Another example that the book gives is that if you sell a home to your children, right, and you give them a deal, right? Let's say the home is worth $175,000 and you sell it to them for $125,000 because you're a nice parent. Well, that technically is a bargain sale, and technically you've gifted them $50,000 if $175,000 is the fair market value. And technically you have to, once again, file a gift tax return, okay, a gift filing, in order to record the fact that you basically, in essence, gave them a gift of $50,000. Now, you didn't give them any cash, but you gave them an asset for a bargain sale, and a bargain sale at a discount requires you to document the difference. Okay? So all these rules that a lot of people don't even know exist, but are out there. And we've got to be careful about, because if you ever get audited, right, the IRS would be very interested in making sure that all these gifts, if you've been doing this, have been reported. Okay, and it doesn't necessarily, once again, mean that you're going to owe any more in taxes. In fact, most times it doesn't. Most of us aren't ever even going to get close to $5.45 million over our lifetimes or in death, but they still want it reported, because if there is a chance of that, even if it's a chance, they'll want to be able to collect on it at some point down the road. Okay, so that's the reason for the gift tax return, or the gift reporting, that needs to be done. And like I say, anytime you exceed $14,000 in gifts to one person, then you should technically file that gift tax filing, or that gift filing, excuse me. Now, if you have 5 kids and you give them each $14,000, you don't have to file anything, right? Because you're at that exclusion, because it's per person that you're giving to in a calendar year. As long as you stay 14,000 or below, you're in good shape. All right, so what are some limitations on the gift reporting? Well, one is that you don't have to gift report anything that you give to your spouse, okay? Your spouse is the exclusion to this rule. Your spouse is an exclusion to a lot of rules, and basically the bottom line is you don't have to report anything that's given to your spouse at any point, or file any kind of gift filing if you're just giving things to your spouse, okay? Now, most people don't even think of this because they have things that they own jointly, right, anyway. But if you did keep things separate, or if you got remarried and then, shared different assets or gave different assets to each other, that would not require any kind of gift filing, okay, even if it exceeded the $14,000, because there's what's called an unlimited marital deduction. There's no limit on how much you can give them in a calendar year, and there's no limit that in the amount that you can give them over your entire lifetime or in death. You can give them any amount you want, and it doesn't matter. There's no estate taxes or gift taxes due. Okay? All right, when we talk about lifetime gifts, the concept of lifetime gifts is this. Instead of keeping all your money for when you die to pass on to your kids in a lump sum, the idea is, why not in life start to give them some funds that they can use and enjoy, and that you can enjoy, the benefits of helping them, okay, and of that gift, instead of waiting till you die and not being able to see the benefits of the gifts that you were able to give, okay? So this is where you have trusts or grandparents that gift $14,000 a year per child, or $28,000 a year per child if it's a joint, if it's a joint situation where they're doing what's called gift splitting. Gift splitting just means that a married couple can give $28,000 because each one of them can give $14,000, right? and we don't worry about which part came from who or what account it came out of. If you're legally married, you can give each one of your kids or grandkids $28,000 in a year and not have to do the gift filing. Okay? So lifetime gifts just have to do with us trying to give those gifts in life. Now, if we have a $10 million estate, one of the things we can do from an estate planning standpoint to avoid having to pay taxes upon our passing is to try to give away as much as we can under the limits that are there while we're living, right? And try to spend down and give down our estate so that we won't have to write a big check to Uncle Sam or to the government when we pass away. So that's another issue with lifetime gifts. Just so you're aware, and hopefully not to confuse you, but some years back when I first got in this business, about the first 5 or 10 years in business as a financial advisor, the rule was there was a separate lifetime gift amount than there was an estate, in death amount. So for estate taxes, it was like $3.5 million, and the lifetime gift maximum was $1 million. So if you gave in life, you could give up to $1 million, and then you could also give another 3.5 in death. Now they've combined that, and the rule, okay, that total exclusion amount is for life and death, right? It's a combined amount, but it's higher. It's 5.45. So you can give $5.45 million in life through gifts and never pay a dime of gift tax. But then if you give anything in your estate, right, when you die, you'd have to pay estate taxes on the full amount because you've already hit your lifetime exclusion, okay, which is basically a life and death exclusion now combined. All right, one of the things that we need to talk about when we refer to gifts is revocable versus irrevocable. A revocable gift is a gift that you retain some sort of ownership rights on and that you can basically pull back, okay? So this is the if I give my daughter $5 and then 2 days later I take the $5 back because I can, because I just can take it right back for some reason, that would be, of course, a revocable gift, a gift that can be rescinded or undone, okay, because I have some sort of control to be able to undo that gift. For a gift to really be a gift as far as tax considerations, it has to be irrevocable, okay, meaning it has to be, it can't be undone, okay. So if I put $100 into my trust and it's the beneficiary on the trust says that $100 will go to BYU, a local college that's a not-for-profit, that is not a completed gift. In fact, it's not even considered a gift, right? Because technically in a revocable trust, I could change that anytime I wanted. I could say, well, I don't like BYU anymore. I want to give that $100 to University of Utah, okay? And until I die and my trust actually pays that out, it's just a revocable gift. And revocable gifts do not get any kind of tax status. They don't go out of your estate technically. They're not a completed gift. For purposes of gift taxes, for estate taxes, and for gift filings, the gift must be completed and irrevocable. Okay? So just keep that in mind. Like if I have a life insurance policy for $100,000 and I put the beneficiary as a church that I want to leave it to, that's still not a completed gift, right? Because I can change the beneficiary to someone else if I wanted to at any point. However, if I put it in an irrevocable life insurance trust, stating that the beneficiary can never be changed, and then I put it, then I give ownership rights and beneficiary rights to the church, that would be then an irrevocable gift, and I would get both a tax benefit from charitable giving like that, but I'd also have completed the gift as far as giving is concerned, as far as gifting rules are concerned. Okay. All right, let's keep looking at things. All right, so for this week on the assignment, I just wanted to look at this really quick. This is the financial planning exercise for the assignment. You'll notice on the requirements, I've changed it to a 2 to 3 page report instead of a 3 to 5 page report. And as long as you get close to 2 pages, we're good, as long as you've evaluated the ins and outs of this scenario. So basically in this scenario, you have a couple. They both were previously divorced and now they're married. They have children from previous marriages, okay? And they have a $1.4 million estate. And they have some other items, and they're just trying to have you demonstrate, based on what the chapter has to say about estate planning, what kinds of things this couple should consider from an estate planning perspective, okay? Knowing that it's probably a goal of both of them to take care of their children, right? Their previous children, their children from previous marriages, excuse me. And that probably is more of a priority than leaving funds and resources to their current spouse, okay? Current spouse is probably second, and then the children of our new spouse is probably a third concern, and maybe not even any kind of priority for the assets that we have, right? And so how could a trust help a couple like this that's got kind of the yours, mine, and ours type scenario, which is very common actually, but what could trust planning or estate planning help with as far as these folks are concerned? And be specific. Go into, they've got this home by the beach, they've got investments, they've got antique furniture, they've got jewelry. Go into each one of these and how estate planning and trust planning could potentially help with their particular circumstance. Any questions on the assignment? So it's just this one financial planning. Okay. Just one financial planning exercise. Sorry about that. I needed to get a drink and now I need to get another one. My throat's hurting pretty good. Okay, should be pretty straightforward, pretty easy, but just make sure that you demonstrate, once again, like we've talked about before, that you've read the chapter and that you can use material from the chapter. Just a quick slide. Wanted to basically state that as far as gifting is concerned, programs like TaxAct and TurboTax will help you, with forms and with requirements for gifting. Your local Liberty Tax or H&R Block, those folks, but you've got to be the one to tell them, right? They're not going to know that you gave a car to your son or daughter, right, that was worth more than $14,000. So these are things that the IRS anticipates or expects that you will report. It's a self-reporting thing. That's our tax system is, we report it. And like I say, it doesn't hurt us other than we might have to pay a little bit for that extra, form as far as gifting is concerned. But we're probably not going to pay gift taxes, like I say, unless we exceed that $5.45 million. All right, so let's talk real quick about, we've already alluded to this spousal exception, which we mentioned, excuse me, the spousal exception is unlimited. So we never have to pay, we never have to pay any gift taxes or lifetime, or tap into our lifetime exclusion based on gifts to our spouse. Okay, that doesn't ever tap into our lifetime exclusion of $5.45 million. I can give whatever I want to my spouse, and it doesn't tap into that at all. Okay, so that's the spousal exception. We talked about lifetime gifts, which are a planning technique because we want to gift over time from our estate as opposed to in life, as opposed to waiting until we die and having to pay estate taxes. It might make sense to give while we're alive and use that $14,000 a year, or $28,000 if we're married. And that's usually the strategy for the ultra wealthy estates and trusts. You'll have children, trust fund babies, right, that get their $28,000 a year, and it might even be $56,000 because they might get, $28,000 for them and $28,000 for their spouse from a trust or from their parents or grandparents. And that's so that they fall below this this exception level, okay, this $14,000 a year. And then, of course, charitable gifts don't count at all towards this maximum of $5.45 million. That's only if we transfer to, family, friends, people. If we're giving money, I can give as much as I want to a church of my choice, any kind of non-for-profit that's a 501c3, which is just the IRS code that states that it's a charitable organization. It's not a for-profit organization, and it's official through the government. So I might not get significant tax benefits if I give too much, but I can get that money outside of my state and not ever have to pay gift taxes or estate taxes if that money goes to charity. Okay? So one of the things that a lot of people will do when they're estate planning or planning for larger estates is they will look into ways, maybe create a foundation or something for their family, or maybe they'll start giving to their church or favorite charity or college or something like that. And this allows them to take money from their estate, move it to things causes that they enjoy, that they like, that they feel passionate about, instead of paying estate taxes to the government, which most people would say that, for example, somebody could do more with with money through a church than our government could do with those same dollars. And so people will usually, want to give to causes as opposed to writing a check to the government. And that's a way you can do it. Okay, that is all the material that I wanted to make sure we covered. Not a lot of material. Like I say, 15.4 is very brief about gifting, and that's pretty much all the major principles of gifting that we've just covered. Having said that, as I mentioned before, the test has some gifting questions, but really you need to think of the test as just basically a comprehensive test over the entire chapter with some repeat questions from last week. Okay, so don't get caught off guard. I know it. The readings and tools say it's 15.4, but really this test is pretty comprehensive when it comes to all the material associated with the chapter. Okay, which is consistent with other classes you've probably had. In fact, if you were in the last class that we had, right, we sometimes would have 2 chapters in a week that we were that we needed to cover. This class, we don't have 2 chapters in a week. We only have one little section, but these tests are usually pretty comprehensive and cover more material. Okay? All right, so you've got 2 hours to do it. In fact, I think you might have more than that. You've got at least 2 hours, to take care of the test this week. But let's spend a few minutes as we go through this. Make sure and let me know if you've got any questions. If you miss anything, if you miss any topics or anything like that, so we can get you that information before we wrap up tonight and send you on your way. Okay, so 50 problems, as I mentioned. Let's see here. I was going to give you a time. 1 second. Yeah, it is 2 hours. So we were right about that. You got 2 hours, 50 problems. If you've read through chapter 15, most of these are going to be pretty straightforward. And like I say, there's quite a few repeats from last week's test. So if you felt pretty good about last week's test or knew that material, you'll be in great shape this week as well. Okay, so number 1 on the test is a repeat question. It has to do with the objective of estate planning. What does the book have to say about the main objectives of estate planning? Okay, just a true-false question, pretty straightforward, but what does the book have to say about the objectives, the main objectives of estate planning? What does the book have to say for number 2 about what estate planning is most similar to? Is it most similar to tax planning? Is it most similar to investment planning? Is it most similar to retirement planning? Is it most similar to insurance planning? What does the book have to say about what estate planning is most closely tied to? We've talked about tax planning, investment planning, retirement planning, insurance planning. All these things go into estate planning. They're all related, right? But the book tells us that 2 of those are more related to estate planning than the other 2, okay, out of those 4 topics I just mentioned. Okay, number 3, once again, main objectives of estate planning. If you're familiar with the main objectives of estate planning or have read that, you'll be able to identify these just fine. That's also a repeat question from last week. Estate planning, the question is worded wrong. It says estate planning us designed to. Of course, it's meant to say estate planning is designed to. So once again, back to the objectives of estate planning, you'll get number 4 right on the test. Number 5, a repeat question from last week about first level death related costs. You'll recall that we had second level death related costs and first level death related costs. You'll need to know some examples of each and what those are before you get to the test for 5 and 6. So those are that's numbers 5 and 6, first level and second level death related costs. Number 7 is a repeat question about how often the book tells us that we should review our estate plan. Okay. This is one of these ones where if you were just to Google how often should I review my estate plan, you will definitely get this one wrong. You definitely want to know what the book has to say, what the chapter has to say, what chapter 15 specifically has to say about how often the book would suggest that you review your estate planning. Number 8, you want to know the definition of a probate estate. Okay, another repeat question, probate estate. Number 9, a repeat question about what would be a justifiable reason to revise your estate plan. So it'll give you some different examples of reasons that you might revise it, and then it'll give you an example of something that would not require revision of your estate plan. You'll want to be able to identify what is required versus what isn't required for an estate plan, as far as what would necessitate an update. Okay, what would necessitate an update? What the book has to say about that. Number 10 on the test has to do with distribution of assets through estate planning. So just need to understand what the book has to say about whether or not there's some pitfalls associated potentially with the distribution of assets. Okay, and this is pretty straightforward. If you just think about it, the whole chapter, the whole point of the whole chapter is to get us to understand that estate planning is valuable, right? It's a good tool. So if there's a question on the test that asks you, is there a potential problem with distribution of assets from an estate? The answer is probably going to be yes, right? Because the whole point of the chapter is to justify estate planning. So could there be potential issues? Yeah, and that's why you need estate planning. So giving you the answer basically to 10. But that's so straightforward. If you just take a step back and think about it, you know, it's a pretty easy one. Number 11, want to know the difference between asset and people planning? Remember the difference between asset and people planning for estate planning? What does the book have to say about that? What is people planning? What is people planning? What is the people planning part of estate planning, I should say? Another potential pitfall of estates or estate planning is insufficient capital. Why is that a problem? Why is insufficient capital a potential problem for estate planning? If you understand that, you'll get number 12 right. Number 13, you want to understand what custodial accounts are. What are custodial accounts? What does the book have to say about custodial accounts? Number 14, another question about the difference between first level and second level death-related expenses. Just being able to identify and differentiate examples of the two. If you understand what the book has to say about first level and second level death-related expenses, you'll be in great shape on those 3 questions now. Number 15 on the test, repeat question on estate breakup. What is an estate breakup? Number 16, a question about life insurance, the uses of life insurance within estate planning. The other class that I'm teaching right now is on, the whole class is about life insurance. It's 334. I don't know if any of you have had that, but basically we talked tonight about how life insurance can be the most important tool, the single most important tool, an effective tool, an efficient tool for transferring assets within an estate. Very tax efficient. It can create all kinds of considerable value. So life insurance can be a great tool for estate planning. And the book basically goes over that and says, hey, here's some good reasons for life insurance within estate planning. Number 17, probate estate again. Another question about probate estate. Make sure you know what the book has to say about what a probate estate is and why you have a probate estate. Number 18 is a repeat question about property held in other states, whether or not that complicates or simplifies your planning. Pretty straightforward. This is not a hard question. Don't overthink it. Would it be more simple to have all your property in one state, or would it be more complicated to have properties in other states? Right? So just if you think about that, does it complicate things from an estate planning perspective to have property in different states? Or does it simplify it? And if you just think about it that way, it's got to be pretty straightforward, what the answer should be on number 18. And like I say, a repeat question from last week. Number 19 is about knowing where documentation is. Another really straightforward question. Is it important to know where documentation is or not? Okay. Is it important to know where documentation is for estate planning purposes or not? Number 20 is one of the objectives of a trust. So the book talks about why someone would use a trust, what some of the advantages and pros are of having a trust. Make sure you understand basically, in basic terms, what those are. So you'll get number 20 right on the test. Number 21 on the test, question about inflation as it pertains to estate breakups. Okay, inflation and estate breakups. Okay, what does the book have to say about that? Number 22, life insurance question again, as far as estate planning is concerned. Number 23 is estate taxes. Who are the estate taxes assessed to? Make sure you understand who the estate taxes are assessed to. Number 24 is an irrevocable life insurance question. Just make sure you understand what irrevocable life insurance trusts are, ILITs. We mentioned them last week. It's a repeat question if I'm not mistaken. Number 25, you want to understand what a will is. We talked about that quite a bit last week. I think this is a repeat question, but what are the main objectives and what are wills? Okay, we're not talking about living wills. Those are medical directives. We're talking about just a will that talks through the disposition of our assets and property, right? Number 26 on the test. Number 26 on the test is a confusing question. The answer is A. 26 on the test is A. Number 27 on the test, you need to understand what sections are associated with a last will and testament. Okay. The book will go over all of the sections that are required for a last will and testament. If you can identify what those sections are, then you'll get this problem right on number 27. Number 28, you need to know what it means to die intestate. What does it mean to die intestate? Number 29, you need to understand that if a will or a trust doesn't exist, what does probate usually do with your assets? Okay, and the answer is that they don't just throw them into the garbage, right? The whole point of probate is to get assets to where government thinks that they should go. Okay, not where you think they should go, but where government thinks that they should go. And government will always favor a current spouse over everyone else. Children, parents, aunts, uncles, cousins. And that makes sense, right? In the case of not knowing, or having a directive on where assets should go, it makes sense that the bulk of those assets should probably go to the spouse, the remaining spouse. But there are a lot of circumstances where that was not the intention of the decedent, the person who passed away, and because they didn't have a will or a trust, that's what the government's going to end up doing. So for number 29 on the test, just know what the government does in case of people not having a will or a trust through probate, and that's that they favor the spouse over everybody else. Number 30, another question that's kind of related to that. Where does government go with assets if there is if they give you a scenario with different family members and who among those family members is going to get assets? And I've pretty well given you the answer to that, but just go and double check what probate does if there's a situation where it's intestate, so there's no trust or no will, and they need to determine where things go. Another thing that the state will determine if you die intestate without a will or a trust is who is going to be the guardian of your children, right? So you need to know that for number 31 on the test. Number 32 on the test, you need to understand the basic requirements of a will. What are the basic requirements of a living, not a living will, of a will? What are the basic requirements of a will? So that the book is going to go over what basically has to be in a will for it to be valid. And you'll want to understand or at least be able to recognize what those requirements are. Number 33, just understand what the book has to say about how to choose guardianship. We went over that last week in a slide. It was the tips on choosing guardian for your children. Just if you reread through that, you'll get number 33 on the test right. Number 34 on the test, The person who writes a will is called what? Who is the person that writes the will? Okay. Who helps to write the will? That's 35 on the test. We talked about this last week. You can just download documents from like LegalZoom or different documents online. If you really want to make sure that a will or trust is done right, this is the type of professional that needs to help you with that. And we've gone over it. And I should go back to 34. 34 is a little bit of a trick question. It says the person who writes a will is called, okay? Technically, the person who writes the will is usually the person who is making the will, right? So even though an attorney is helping with it, and I'm giving you the answer to number 35, but even though an attorney is helping with it, technically you, if you're the one drawing up, what should be said, are the writer, okay, of the will, and the attorney is the helper. They're the professional advisor for the will or the trust. So that'll help you with 34 and 35. 36, once again, requirements for a valid will. 37, requirements for a valid will, being able to identify requirements versus, frivolous things that the book adds in. So as long as you know what the definite requirements of a will are, you'll be in good shape. Number 38, just know what rights a testator has. What rights do a testator have? What is a letter of last instruction? What does the book have to say about what you can do with a letter of last instruction? That would help you for 39 and 40. What are letters of last instruction and what can they involve? What can they include? Number 41, just need to know what an executor is. Who is an executor? What is their role? What do they do? Make sure you understand how we look, what is a gross estate, okay? So 42 and 43 and 44, 42, 43, and 44, just when the book talks about how you calculate a gross estate, just make sure you know what's included and what's not included in a gross estate. That's 42 through 44, so 3 problems based on gross estate. 45 just has to do with what the book has to say about updating an estate plan. Can you come up with an estate plan and then just leave it for 50 years, or do you need to update it? Pretty straightforward, pretty easy. What does the book have to say about that? Number 46, adoption. How does adoption impact estate planning? What does the book have to say about adoption and how it affects estate planning? Number 47, that's the definition of an intestate again. Okay, we've already gone over that, but just make sure for 47 you understand what dying intestate means. Number 48, objectives of estate planning again. Just a basic question about the objectives of estate planning. Number 49, you'll want to know whether or not a will, okay, a regular will, is required by state law or not. It's a pretty straightforward question. Don't overthink it. But what does the book have to say about whether or not states require wills? Okay, do you have to have a will or do you not have to have a will? Is it like car insurance where they make everybody have it, or is it like life insurance where it's up to you? Okay, know what the book has to say about wills and whether or not they're required or not. Number 50 on this test has to do with intestacy. So we talked about intestate, we talked about intestacy. Those are related terms, related concepts. If you understand what those two mean, you've got 3 or 4 problems on the test right. Okay, that is all I have for tonight. Those are all the questions for the test. Any repeats that you need, Mr. Reyes, before we wrap up? Okay, have a great night, have a good week. Let me know if you have any questions or concerns as you go through the material. And we'll talk to you next week. Thanks again for coming back in tonight. Sorry for the delay on the course this evening, the lecture. But yeah, should be in good shape this week, and let me know if there's anything we can do. Thanks, man. Have a good one. Yeah, you too.